In 2017, Warren Buffett stood in front of 40,000 shareholders and admitted he was, in his own words, too dumb to see what Amazon would become. The greatest value investor in history, the man who turned Berkshire Hathaway into an $800 billion empire, confessing he missed one of the greatest wealth-creating machines of all time.
How does that happen?
Today, we are going to break down the Amazon story through the lens of value investing.
Not to celebrate hindsight, because that is easy.
But to understand what traditional value analysis got right, what it got spectacularly wrong, and most importantly, what this teaches us about how to think about value in a changing world. Because this is not just a story about one stock. It is a story about the evolution of value investing itself. To understand why value investors avoided Amazon, you have to put yourself in their shoes. It is May 1997. A company that sells books online goes public at $18 a share, valuing it at roughly $438 million. It has $148 million in revenue and is losing money. Now, if you are a disciple of Benjamin Graham, you run this through your checklist.
Price to earnings ratio? There are no earnings. Book value? Negligible. Margin of safety?
The stock is priced for perfection in a business model nobody has proven works at scale.
Every traditional value screen flashes one word: avoid.
And for the next 2 years, the stock kept climbing. By December 1999, Amazon hit $106 a share. The price-to-sales ratio exceeded 25. Analysts were inventing new metrics because the old ones all said the same thing: this makes no sense. And here is where value investors made a reasonable call. They looked at a company with no profits, a sky-high valuation, and a dot-com frenzy that was clearly unsustainable.
They said no. And honestly?
Based on the information they had and the framework they used, that was a defensible decision. Then the bubble burst. From its December 1999 peak of $106, Amazon fell to $5.51 by October 2001.
That is a 94.8% decline. Nearly 95 cents of every dollar, gone. Value investors felt vindicated.
They had warned that Amazon was overpriced, and the market had just proven them right in the most brutal way possible.
Many wrote Amazon off entirely.
Some of the most respected investors in the world said this was a company that would never justify its valuation.
But here is what most of them missed.
Even as the stock price cratered, the business kept growing. In 2001, the same year the stock hit its low, Amazon posted $3.1 billion in revenue, up from $2.8 billion the year before. They turned their first quarterly profit in the fourth quarter of 2001, $5 million.
It was tiny.
But it was there. The stock had crashed, but the business had not. That distinction is everything in value investing, and most value investors were not paying attention anymore.
So what did they miss? 3 things.
First, they missed the moat being built in real time.
Jeff Bezos was not trying to turn a profit. He was reinvesting every dollar into building something that would be nearly impossible to replicate. Fulfillment centers. Logistics networks.
The Prime membership ecosystem.
And most dramatically, Amazon Web Services. AWS launched in 2006.
By 2023, it was generating over $91 billion in annual revenue with operating margins above 25%.
That is not an online bookstore. That is a toll booth on the internet.
Second, they missed the free cash flow story. One of the few value investors who did see it was Bill Miller at Legg Mason, the man who beat the S&P 500 for 15 consecutive years from 1991 to 2005. Miller started buying Amazon in the early 2000s, right after the crash, when most value investors would not touch it. His insight was simple but profound. He said, "Stop looking at the P/E ratio.
Look at free cash flow." Bezos had been explicit about this from day one.
In his very first shareholder letter in 1997, Bezos wrote that free cash flow per share was the metric that mattered, not earnings per share. He was telling everyone exactly what he was doing.
Most value investors were not listening because the signal did not match their templates.
Third, and this is the deepest lesson,
they missed that Bezos was running Amazon on value investing principles even though it did not look like a value stock. Long-term thinking? Bezos was planning in 7-year cycles while the market judged him quarterly. Capital allocation discipline? Every dollar went into building competitive advantages. Margin of safety? He built it through diversification, first retail, then marketplace, then AWS, then advertising, so that no single failure could kill the company. So what does this mean for how we think about value investing? It does not mean you should throw out Graham and Buffett and buy every high-growth company with no earnings. Most of those companies fail. Amazon is a survivor, and survivorship bias is real. But it does mean that value investing has to evolve with the economy. Graham wrote Security Analysis in 1934, when value meant tangible assets, factories, and inventory. Buffett himself evolved from Graham's pure cigar but approach to what he calls buying wonderful companies at fair prices. He credits Charlie Munger for that evolution. The result tells the story. If you invested $10,000 in Amazon at its IPO price of $18 a share, after 4 stock splits including the 20-to-1 split in June 2022, you would have roughly 133,000 shares today. At current levels, that investment is worth more than $20 million. Even Buffett came around eventually. In the first quarter of 2019, Berkshire Hathaway disclosed its first Amazon position. Better late than never. The real lesson is this: value investing is not a formula. It is a philosophy. The philosophy says, understand what a business is worth, and pay less than that. But understanding what a business is worth requires understanding the business. Not just running a screen. Not just checking a P/E ratio. Actually understanding how the company makes money, why customers stay, and what the world looks like in 10 years. If there is one thing I want you to take from the Amazon story, it is this: the price you pay matters, but understanding what you are buying matters more. Every great value investor who missed Amazon did so not because their math was wrong, but because their understanding of the business was incomplete. They measured what was easy to measure and ignored what was hard to see. As Buffett himself has said, it is better to be approximately right than precisely wrong. And with Amazon, a generation of value investors was precisely wrong. Tomorrow, we are looking at another company that divided value investors for years, Tesla. A very different story, with a very different lesson. If you do not want to miss that one, subscribe and hit the bell. I would love to hear from you in the comments. Did you invest in Amazon early, or did you watch from the sidelines? What did you learn from it? This is the Daily Investor. I will see you tomorrow. This content is for educational purposes only and does not constitute financial advice. Always do your own research and consult a qualified financial advisor before making investment decisions.